A $1 million nest egg can generate $80,000 to $100,000 a year of tax-free income. In this episode, I'm going to give you some stories of IUL owners that get 8 to 10% annual tax-free payouts for retirement income on $1 million nest egg, $2 million, even $8 million nest eggs that we help them accumulate at average returns of 8 to 10% totally tax-free. So my name's Doug Andrew. I've been a retirement planning specialist now for north of 48 years. During that time period, I've helped thousands of clients optimize their assets, minimize taxes, and empower their authentic wealth. And a lot of times they come to me because they want to save for long-term goals like retirement, maybe college savings accounts for their kids and grandkids, maybe working capital for business or real estate management or emergency funds. But they want a safe place to earn predictable rates of return that are tax advantaged and that will keep up with inflation. And I say, is that all you want? I can do better than that. And they go, I'm all ears. Okay. Now, if you've watched any of these educational videos on this channel, you will quickly learn that one of my favorite financial vehicles or instruments that allows people to accumulate their money totally tax-free, not just tax-deferred, totally tax-free, is a max-funded indexed universal life insurance contract. But it has to be structured correctly and funded properly. Unfortunately, over 99% of those out there in America do not accomplish what I'm about to explain to you. And that's why I have a group called IUL Insiders, where I teach financial advisors and professionals how to do it correctly. Then it qualifies to be a laser fund. And at the end of this episode, I want to gift you a copy of my most recent 300-page best-selling book called The Laser Fund that teaches you how to diversify and create the foundation for a tax-free retirement. When you read and study this book, you'll know more than 99% of advisors do. And I'll be able to point you to the ones who actually have taken the time to learn this. Now, I want to just cut to the chase because you can accumulate your money at rates of return averaging 8 to 10%. Now, there are some periods of time, some years, where Indexed Universal Life has credited me and my clients, IUL owners, with 16%, 25%. Yeah, 2017, many of our clients locked in gains of 25% tax-free. They started the year 2017 with $1 million, and 12 months later, it was worth $1,250,000. They made 25%. That also happened in the year 2021. But 2021 was the COVID pandemic, and they had the opportunity to use a strategy, an opportunity that only comes by maybe once every decade or so. And in March of 2020, the market dropped 30% in 1 month because of COVID-19. And our savvy IUL specialist told their clients, link to a 1-year point-to-point with no cap. Now, generally, we don't give that advice because in a normal economy, you want to have a 1-year point-to-point strategy where if the S&P goes up 12, you get credited with 12. There might be a cap. They won't pay you any more than 12 if it goes up more than that. But if you're pretty convinced that the market's going to go up higher, you can choose this strategy. So we figured that the market would likely come back after COVID-19, and it did. And 1 year later, in March of 2021, the market was up 66.33% from the bottom of March of 2020. And so with that strategy, the insurance company deducts 5% or a spread. So the market went up 66.33, minus 5%, they netted 61.33. Yeah, people got credited 61%. We had a client with $830,000 in March of 2020 without adding a dime. He ended up with $1,380,000 some odd thousand 1 year later. He made over $500,000 tax-free in one single year on his IUL. So when critics out there, naysayers say, oh, I've never seen an insurance policy do that. Well, hello, I could show you hundreds of policies that have been earning these rates of return, but let's just bring it down to a nice little average of 7 to 10%. I have averaged 9.62% since 1980. This was before Index Universal Life. This was just Universal Life. I've actually averaged more like 11, netting 10. Only 1% was the cost of the insurance that the IRS said had to be there in order for it to be tax-free, okay? But I can earn 11 and net 10. I can earn 9 and net 8. I can earn 25 and net 24. I can earn 61 and net 60 by structuring it correctly. And so I'm going to gift you a copy of my best-selling book at the end of this episode. So stay with me here, but be sure and subscribe to this channel. It's free, and be sure and click that little bell so you'll be notified every time I post a new educational video, which I do almost on a daily basis. So let's go back to how people are able to generate 8 to 10% payouts tax-free. Many times when I teach a live event, I will start a 6-hour retire by design event by telling the audience, in this 6 hours, you will learn how an insurance company earning 4% on their general account portfolio. That's how much they're earning on the billions they're managing. They're earning 4%, how they can afford to pay you 8%, even though they're only earning 4%. And they go, really? I go, yeah. And also, you will learn how that insurance company can give you a 10% payout. In other words, that you can accumulate $1 million and they'll send you $100,000 a year. That's a 10% payout. 10% of $1 million is $100,000, even though they're only crediting you 8 without depleting your $1 million principal. And they go, no way. And I say, yes way. In fact, you wouldn't believe how many financial advisors do not understand how to do what I just said. So you can watch episodes on this channel, but I'll give it to you in a nutshell. Now, if you're accumulating money in an IUL policy, you can sock away $500 a month. And based upon these average rates of return, 9.6%, $500 a month in 30 years will grow to $1 million. You can start out with a lump sum of let's say $250,000. And then add $2,000 a month, and in 10 years, you'll have $1 million. It's just math, compound interest. You can put in $500,000 into the policy, and in 7.5 years, it'll double to $1 million, okay? I'm just using simple math based upon the average rates of return. But let's just take the snapshot in time when you're going to start turning on the income. It doesn't have to be after age 59 and a half. It's any time you want to start creating income, and it's totally tax-free under sections of the code. It's mainly 7702. Now, I talk about that in other episodes. So let's just use $1 million example, and you can extrapolate from that. If you have less money than that, if you have only 100,000, it's 1/10 my example. If you have 10 million, which some of our clients do, it's 10 times this amount. So for every million you have, if you want to turn on income, and if you want to take out the most income without depleting principal, you basically pull out the equivalent of your interest. And in various episodes, I talk about there's the dumb way and there's the smart way. Now, there is also the sad way. That's by dying. That's one heck of a return, but I don't recommend it because you have to die. But you have $1 million in there, you die, you'll leave behind $2.5 million. That's one heck of a return, but you're not around to benefit from it, but your spouse is, or your kids or grandkids, your beneficiaries. But if you live your $1 million, you can withdraw the equivalent of your interest, and you can do that clear up to your basis, the amount you put in, and it's tax-free. But if you withdraw and you have recovered your basis, you now have to pay tax on anything thereafter because now you're into your gain. So I tell people how savvy investors do this. They borrow the equivalent of their interest. Why would you do that? Because there's two ways to borrow. When you borrow money, that's tax-free. You don't have to pay tax on any money you borrow. The IRS says borrow the equivalent of your interest. So just reason with me. You've got $1 million in there. If you had $1 million in the bank, you could go borrow money from the bank, but what would the bank do? They would probably charge you 5% and only credit you 1%. The insurance company does sort of the opposite. If you borrow, let's say you got $1 million earning 10%, you borrow $100,000, which is the equivalent of your interest, but now your million is still there, earning 10%. So at the end of the year, your million is now worth $1,100,000 minus the $100,000 loan equals the same million that you would have pulled out and maybe triggered tax. But loan proceeds are tax-free. So far, so good. Now, that $100,000 loan is just a phantom loan, meaning it's not due and payable during your lifetime. It's washed away when you ultimately die. But if you do that every year, it's going to grow 100, 200, 300, 400,000. But this is going to grow 100, 200, 300, 400. This minus this equals the same million had you pulled out the money the dumb way and paid tax. And so at the end of the day, you could go 20 years and have a $2 million loan balance. And this is now worth $3 million. $3 million minus $2 million equals the same million that you would have had you pulled it out the dumb way and paid tax all those years. But instead, you had tax-free income. Now, there is one little catch. In order for it to be construed a true loan, the IRS says the insurance company has to charge you a nominal, a statutory minimum interest rate. That's usually around like 2%. So they charge you 2% on the loans, but they credit you the same rate, 2%, on the money that is collateralizing that loan. And on the original million, you're still earning, 8 to 10%. If you're going, what? In other words, it's zero cost. It doesn't cost you anything to call it a loan. So far, so good. Let me go one step further. You know what smart people do? They use the index loan. You tell the insurance company, you can charge me 4%. Why? Because if they charge you 4%, it's not due and payable during your lifetime. They will credit you on all the money as it grows, not just the original million. They'll credit you the index rate of 8, 10, 25%. Hello? I had a client in 2017 that borrowed $1 million out of his IUL policy. He borrowed at 5% on $1 million. That's 50 grand. He didn't have to write out a check for that interest. They deducted it from the 25% he earned on his policy. He earned 25 or 250 grand minus 50. He netted 20% or 200,000 tax-free on his million while he was using that million in his business. And he actually made an extra 3 million in his business. If this is blowing you away, good. You need to learn this because you're missing out. This is how money works. So when you do this, let me come back full circle. If the insurance company is earning 4% on their general account portfolio and you tell them link to an index, they're taking the 4% interest on your million, that's 40,000, and they're buying upside options so that if the market goes up, they pay you 8, they pay you 12. But if the market crashes, you don't lose your million, okay? The options expire worthless. But if the market goes up, the insurance company has the wherewithal to pay you 8 or 12%, even though they're only earning 4, because they bought upside options. And if the market goes down, they expire, but that's what you're willing to do. This is how an insurance company can afford to pay you 8, even though they're only earning 4, because you're telling them you can take the 4% interest, the money, and buy upside options, and they'll have the money to pay you a higher rate if the market goes up. But if the market goes down, you gave up the 4%. So far, so good. And then I told you that the insurance company, when you take out money, if you borrow at 4 and they keep crediting you 8, how much more is 8 than 4? Don't say 4. That's double. That's 100% more. If you borrowed at 4 and you only earned 6, that's 2 extra percentage points you're earning over and above what you're paying. That allows people to be able to pull out 10% out of $1 million nest egg, 100,000, without depleting principal. Now, if I went a little bit fast, review this, rewind it. Because I basically told you how an insurance company earning 4 can afford to pay you 8. They can also afford to give you 10% payouts without depleting principal if you pull out your money the smart way and you let them charge you 4 and let them keep crediting you just 6% or higher. These are illustrated in my book. So this is what I want you to do. if you don't learn this, you're going to kick yourself. Go to laserfund.com, laserfund.com, or click on the link below, and you contribute a nominal amount towards the shipping and handling. You have to have some skin in the game. I'm not trying to sell you a book. I will pay for the book. I'll fire out a free copy to you. And there's also options there to listen and learn, or watch and learn if you want, or there's even an 18-hour masterclass. But check out some of the online webinars that we teach on a regular basis. And if you want to talk to a specialist, an advisor who understands how to implement this correctly, be sure and do that when you're in there claiming your free copy, okay? Now, this is actually 2 books in one. This side is for the left brain thinker. This has all the charts and graphs and explanations. If you learn more by stories, you can flip it over and read this one, 100 pages, 12 chapters with 62 actual client stories for the right brain learner. If you want to learn with your right brain and your left brain, read the whole book, okay? But claim your free copy, then be sure and connect with us, and we can point you to an advisor that will help you implement a laser fund correctly and diversify if your advisor doesn't understand how to do this. If you think your advisor does, you will read on page 195, 14 questions to ask your advisor. And if they cannot answer those 14 questions off the cuff, if they go, oh, I don't know, I'll have to check that out. Or if you can tell they're faking an answer, that's a red flag. They either need to join our group IUL Insiders to learn, or if they refuse, if they think they know it all, I would change advisors, and I can point you to the ones who know how to implement this correctly. This is about you and your brighter future. I do not want you to outlive your money. So seize the opportunity.